Hey everyone, welcome back to the channel. Let's talk about something that's been making waves lately, the so-called Trump stock market surge. And you've probably seen the headlines, right? Market hits record highs after Trump's victory. But here's the thing, those records, they're already starting to fade. Let's dive into what's really happening here. First off, when Trump won the election, the stock market reacted like it just hit the jackpot. The Dow Jones spiked over 1,500 points the day after the election, and the S&P 500 had its best post-election day session ever. Investors were hyped. Deregulation, corporate tax cuts, and tariffs on imports. Wait, tariffs? Yeah, we'll get back to that. And then, fast forward a few days and we're already seeing the hangover set in. The Dow dropped over 800 points from its peak, and stocks tied to vaccine makers, like Pfizer and Moderna, took a hit after Trump named RFK Jr. to lead the Department of Health and Human Services. That's the same RFK Jr. who's been, let's say, controversial about vaccines. Traders didn't love that. But let's take a step back. Why did the market rally in the first place? 2 words: uncertainty resolved. The election was messy, but the outcome gave Wall Street a sense of clarity. No one wanted another drawn-out, contested election. But clarity doesn't equal long-term confidence, and that's where things get dicey. You see, Trump's economic policies on paper are a mixed bag. Sure, corporate tax cuts and deregulation sound great if you're a CEO. But tariffs? Those hit consumers and businesses alike. The proposed 10 to 20% tariffs on imports, with a 60% tariff on Chinese goods. That's not just a slap on the wrist for foreign competition. It's a gut punch for American companies relying on those imports. UBS strategists estimate these tariffs could shave up to 10% off U.S. equity profits. So yeah, the market's enthusiasm might be a bit premature. And let's not forget the Federal Reserve. Jerome Powell, the Fed chair, isn't exactly rolling out the red carpet for Trump's plans. He recently said there's no rush to lower interest rates further. Translation: don't count on cheap money to keep the market afloat. Bond yields are already rising, which usually spells trouble for stocks. Rising rates mean higher borrowing costs for companies, which can squeeze their profits and send stock prices lower. Now, Trump's a big fan of the stock market. It's practically his personal scoreboard. Remember when he used to ask, "How's your 401k doing?" Yeah, he knows that market performance ties directly to his popularity. That's why some strategists think he might backpedal on his more aggressive policies if they start hurting stocks. But here's the catch. That kind of meddling can be just as destabilizing. Markets hate uncertainty, even when it comes from someone trying to save the day. So where does that leave us? Honestly, the market's walking a tightrope right now. High valuations, rising interest rates, and mixed signals from policymakers make this a fragile situation. Investors are trying to stay optimistic, but the risks are stacking up. For those of us not playing in the big leagues of Wall Street, what does this mean? It's a reminder to stay cautious. If you're investing, focus on diversification and long-term goals. Don't chase the highs and don't panic during the lows. And remember, the stock market isn't the economy. Sure, the market rallied after the election, but that doesn't mean every American is feeling the benefits. So what do you think about the fading Trump market? Is it a temporary dip? Or are we in for a rough ride? Drop your thoughts in the comments, and don't forget to hit that subscribe button for more insights like this. See you next time.